Have you ever wondered why your rent or higher, your groceries cost more, or why your credit card interest rate just went up? Spoiler alert, it's not just bad luck, it's the Federal Reserve. In this video, I'm breaking down what the Fed actually is, how it operates, and why it has so much power over your money, whether you like it or not. Let's dive into the secret world of the most powerful bank you never voted for. Part 1. What is the Federal Reserve? Alright, so let's start simple. The Federal Reserve, the Fed, is the central bank of the United States. But unlike your neighborhood bank where you deposit money, the Fed doesn't deal with everyday people directly. It's more like the bank for your bank. It was created in 1913 after a series of banking panics that made people lose trust in the financial system. Think of it as a firefighter, a traffic cop, and a wizard all rolled into one. Weird, right? But stay with me. Part 2. Why the Fed exists. Imagine a town where the traffic lights randomly go from green to red without warning. Chaos, right? That's kind of how the economy was before the Fed. Banks would crash, people would panic, money would dry out, and it would trigger recessions. So the Fed was created to keep the economic traffic flowing smoothly. Its three main jobs are 1. Control inflation. 2. Keep unemployment low. 3. Stabilize the financial system. Part 3. Meet the Fed's toolbox. The Fed doesn't make money by selling things. It uses tools to control the flow of money in the economy, just like a plumber managing water pressure. Let's meet the toolbox. Tool 1. Interest rates. This is the Fed's favorite tool. When the economy is too hot, like prices going up too fast, the Fed raises interest rates to cool things down. That makes borrowing money more expensive. Result, you might think twice before taking that car loan or mortgage. Businesses also slow down on expansion. When things are too cold, like during a recession, they lower rates to encourage spending. Tool 2. Quantitative easing. This is when the Fed buys government bonds or mortgage-backed securities to pump money into the economy. It sounds complicated, but it's basically injecting cash to make credit cheaper and more available. Tool 3. Reserve requirements. This is how much money banks must hold and not lend out. Changing this affects how much banks can loan. Part 4. How the Fed affects you. Okay, now here's where it gets personal. Let's say you're someone like Simpson, our average American. Simpson has a credit card, a car loan, some student debt, a dream of owning a home one day. When the Fed raises interest rates, Simpson's credit card rate goes up, his car loan gets more expensive, mortgage rates go higher, he gets less value for his money, so suddenly, Simpson is paying more just to live the same life. On the flip side, if Simpson has savings, he might earn more interest on them. So not all bad, right? But here's the kicker. Businesses feel this too. They cut back on hiring, investments slow down, and the economy can stall. Part 5. Inflation and the Fed's tightrope walk. The Fed's biggest enemy? Inflation. When your dollar buys less over time. Let's say Simpson used to buy a burger for $5. A year later, it's $6. That's inflation. The Fed wants a Goldilocks economy. Not too hot, not too cold. But when inflation spikes, they raise rates aggressively. That cools inflation, but it also risks triggering a recession. It's a delicate balancing act. Tighten too much, people lose jobs. Don't tighten enough, prices spiral. So yes, the Fed controls inflation. But that control comes with consequences, especially for everyday people. Part 6. Who controls the Fed? Okay, but who's actually pulling the strings? The Fed is technically independent from the government. It's led by a board of governors, with Jerome Powell as the current chair. They aren't elected by voters. They're appointed by the president and confirmed by the Senate. Once in, they make decisions based on data, not politics. At least that's the theory. But critics say the Fed can be too slow, too academic, or even too friendly with Wall Street. Some believe the Fed has too much power. After all, a group of unelected officials can influence your rent, your job, and the economy with a few words. Part 7. The Fed and conspiracy theories. Let's talk about the elephant in the room, conspiracy theories. Some people think the Fed is secretly controlling the world, or that it's run by a private cabal. Here's the truth. Yes, the Fed is powerful. Yes, its decisions can make markets rise or crash. But it's not a secret society. It publishes its decisions, holds press conferences, and releases meeting notes. Still, the fact that so few people understand it makes it feel shadowy. Part 8. So is the Fed good or bad? Great question. The Fed has helped prevent financial meltdowns, but it's also been blamed for causing bubbles and crashes, like the 2008 financial crisis and arguably inflation. It's not perfect, but without it, the economy might be a whole lot messier. It's like asking if referees are good or bad. Depends on the call, right? So, what can you do? You may not control the Fed, but you can understand it. That means watching how interest rates change, managing your debt wisely, thinking long-term with your money, because in this economy, knowledge really is power. Smash that like button if this made you smarter. Subscribe for more simple breakdowns of big economic stuff. And next time your rent goes up, don't just blame your landlord. Remember, the Fed might have had a hand in it. Thanks for watching.